So we're going to start with taxes. And we believe that there is an enormous opportunity to step back a little bit and look at our tax system in this state right now. We obviously have a couple of different types of politicians who are running our government now. We have some bipartisan initiatives that we think can move forward. But a year ago, we stepped back and we thought, who are the smartest people in this country on taxation? Not just on tax levels, but on tax mixes, on how we use our taxes to make sure that government's doing what it does, but isn't exceeding the proper bounds of government. And we looked around the country and we found the brightest people in this country on taxes are at the Tax Foundation. So we approached them, Katherine Loughead, Bishop Henchman, and asked them if they would do what they've done in other states, in 8 or 9 other states, come in and spend a year looking at our tax code in Wisconsin. So I and some of my colleagues at the Badger Institute have spent the last year really crisscrossing the state with both Katherine and Joe, but also 4 other representatives of the Tax Foundation, talking to business leaders, policy leaders, our elected officials, just regular folks who pay taxes, to try to get a handle all over the state on what the perspective is of people who are trying to prosper and create opportunity in this state. So we did that, and then beyond that, the folks from the Tax Foundation have spent the better part of a year looking at contiguous and competitor states, looking at the folks next door, elsewhere in the Midwest, elsewhere in the country, and trying to ascertain exactly where we stand and how we can do better on our tax code in the state of Wisconsin. So without further ado, I want to ask the folks from the Tax Foundation to come up and show us what they found on how we can do better in the state of Wisconsin on taxes. Katherine Loughead and Bishop Henchman.
Thank you so much, Mike, for that kind introduction. And thank you all so much for being here today to discuss options for reforming Wisconsin's tax code. It's great to be here in the state capitol to share our research and findings. As Mike mentioned, over the course of the past year, our team at the Tax Foundation teamed up with the Badger Institute to do an in-depth study of the state's tax code. This process included meeting with taxpayers from all walks of life, including legislators, CPAs, tax attorneys, business owners, and everyday taxpayers to hear their perspective on what's working and what could use improvement in the state's tax code. Hearing from Wisconsin taxpayers themselves was a critical part of this process. After all, you guys are the ones who interact with the tax code on a daily basis. Those conversations, combined with Badger Institute's deep knowledge of Wisconsin's policy history, as well as the Tax Foundation's bird's eye view of what tax reform looks like in other states, helped us formulate 4 comprehensive options for tax reform here in Wisconsin to get the conversation started. I'll walk through those 4 reform options toward the end of my presentation, but first I want to give a little bit of context as to why comprehensive tax reform is necessary. I'll start by sharing the highlights of our research on Wisconsin's economy and tax structure. Next, I'll spend some time talking about each of Wisconsin's major taxes: individual, corporate, sales, property, and unemployment insurance taxes, to explain some of the problem areas we found. During the last part of my presentation, I'll walk through the 4 options for comprehensive tax reform that are outlined in the publication that you should have received on the way in today, or you can pick up as you leave.
And then my job is to be Vanna White, where I will, if you can see the screen, great. If you have the book, I'm going to be telling you what pages the charts and stuff that we're going through is on. And then I also ask scripted questions like this one. Katherine, out of all the policy priorities in front of the Wisconsin legislature, tax reform is obviously just one of many. Why should tax reform be one of the priorities Wisconsin focuses on?
Well, that's a great question, Joe. I am so glad you asked. I have 3 reasons for you. Number 1, comprehensive tax reform will help Wisconsin better compete with other states. States are constantly competing with one another for new residents and for business investment, and taxes are an important factor businesses take into consideration when deciding where to locate or expand. A quick point I'd like to make on this, and I think Mike and Michael at the Badger Institute can attest to this: Every single time our team at the Tax Foundation traveled to Wisconsin over the past year to interview stakeholders, and this is our 7th trip to the state, the subject of Illinois' tax and budget woes entered the conversation. Most of the Wisconsinites we spoke with reiterated that while Wisconsin's tax code is bad, at least things here aren't quite as bad as they are in Illinois, where residents are leaving in droves. And as a former Illinois resident who has since moved away, I can also attest that I am so glad I am no longer paying taxes in Illinois. While it's great Wisconsin's tax code is better than Illinois' in a lot of ways, being better than Illinois is not good enough. There are 48 other states Wisconsin has to compete with, and compared to the rest of the nation, Wisconsin's tax code doesn't stack up so well. The second reason I'll give for why tax reform is so important is that a tax code can build on a state's strengths and compensate for its weaknesses. You're the ones who know best what Wisconsin's strengths are: a strong education system, a hardworking population, a manufacturing presence that is stronger than many other states, and obviously the best cheese curds in the country. However, if tax collections are so volatile that they disrupt the budget structure, if tax collections don't grow along with the economy, and if taxes deter investment and job creation, then the tax code is holding the state back from reaching its full potential. Third, Wisconsin needs a tax and revenue system that works. Whatever your personal views are on education, healthcare, social services, and other state priorities, a simple, stable, modern tax system is a prerequisite for achieving those other objectives. Now, to my first point about how tax reform can help Wisconsin compete with other states, I'd like to share some of the highlights of our research regarding Wisconsin's economy and current tax structure. Wisconsin's economy is the 20th largest in the US overall, but only the 25th largest when adjusted for population. As you can see from the chart that we're about to put on the screen, Wisconsin's economy has grown consistently in recent years, paralleling the economic growth experienced by the US overall. But real GDP per capita consistently remains about $3,000 below the national average and trails behind Illinois, Minnesota, and Iowa. So what's driving the state's economy? I'm sure it comes as no surprise to you that agriculture is number one. When looking at non-farm employment, as shown on the PowerPoint, manufacturing comprises the largest sector of the economy. So there's a lot going on in this chart, but I'd like to point out two key findings. Manufacturing's share of the economy has declined over time, but has stabilized over the course of the past decade, as seen in red. Second, professional and business services, shown in light green, have increased as a share of the state's economy. As I just mentioned, Wisconsin's economic growth is below the national average, and so is personal income per capita. Over the past 9 decades, Wisconsin's personal income per capita has remained consistently below the US average, and that gap has widened in recent years. Today, Wisconsin's personal income per capita is about 5% lower than the national average. Migration is another data point to look at. While a lot of people are moving into Wisconsin, especially from Illinois, overall net migration is an outflow, and it has been that way every year since 2005. This present reality departs from the trend of the early 1990s and early 2000s, when the state saw a net annual inflow of new residents on a pretty consistent basis. Now let's take a look at Wisconsin's tax structure.
Page 28.
Here's a makeup of Wisconsin's tax code over time. Currently, compared to the national average, Wisconsin over-relies on individual income taxes and property taxes as a share of overall tax collections, while under-relying on sales taxes. And if you're curious to learn more about how Wisconsin's tax mix compares to other states in the US average, we have more information on that throughout the book. Each year, the Tax Foundation publishes our State Business Tax Climate Index, a publication that compares state tax structures across over 100 different policy variables.
Page 30.
The index gives state tax structures an overall ranking, as well as component rankings for each of the major tax types: individual, corporate, sales, property, and unemployment insurance taxes. Wisconsin currently ranks 32nd overall, and that's with 1 being the best and 50th being New Jersey. Wisconsin currently outranks Illinois 32nd to 36th, but that's because Illinois has taken steps in the wrong direction and has recently passed you on the way down. Indiana is the only one of your neighbors that ranks within the top 10. Here we see Wisconsin's overall index ranking, as well as its rankings on each of the 5 different components. Wisconsin's sales tax is the best structured part of its tax code, ranking 8th in the nation. While it may sound surprising, Wisconsin's property tax structure is actually slightly better than average. Unemployment insurance taxes are Wisconsin's worst ranking tax, which we'd love to help address, but that can be tackled in a separate conversation. We do present some ideas toward the back of the book as well, though, if you'd like to learn more about UI taxes. But really, it's Wisconsin's individual income taxes and corporate taxes that really drag the state down, and it's those taxes we prioritize most in our comprehensive tax reform options. So let's now take a look at each of Wisconsin's major taxes, starting with individual income taxes. So who pays individual income taxes? The answer might surprise you. It's not just Wisconsin families. 80% of Wisconsin's farmers, 2/3 of manufacturers, and nearly half of financial insurance firms pay individual income taxes because of how they're structured.
Sorry, this is page 43.
That's because the business income of sole proprietorships, partnerships, LLCs, and S corporations passes through to business owners' individual income tax forms, meaning they pay according to the individual income tax structure rather than paying the corporate income tax. Economists have consistently found that individual income taxes can have a significant impact on an individual's decision to become a self-employed entrepreneur, and that the progressivity of an individual income tax can discourage entrepreneurial risk-taking and self-employment, regardless of the entrepreneur's level of educational background. High income tax rates also reduce investment, hiring, and small business income growth. But even C corporations that pay corporate income taxes pay attention to individual income taxes, as they can reduce the quality and quantity of the labor pool that's willing to put up with high tax jurisdictions. With this in mind, let's take a look at how Wisconsin's income tax is currently structured.
Page 38.
This table shows Wisconsin's individual income tax rate schedule for tax year 2018 for single filers and married couples filing jointly. There are 2 things I'd like to point out here. The first is that Wisconsin's individual income tax is very progressive. Taxpayers with taxable income that falls entirely within the bottom bracket are actually taxed at a lower effective rate than they would be with the same amount of combined income in most other states. However, Wisconsin's rates increase quickly with increases in marginal income. In fact, even Wisconsin's second to bottom rate at 5.84% is higher than the top rate in 20 of the states that have an income tax. This means it's not just the wealthy who face high tax rates, but middle income taxpayers pay more in income taxes in Wisconsin than they would with the same amount of taxable income in most other states. Wisconsin's income tax is even more progressive than the rate schedule shows, with provisions like a refundable earned income tax credit that lowers the tax burden toward the lower end of the income spectrum. The second thing I'd like to point out is that Wisconsin has a marriage penalty. When comparing the marginal income tax brackets for single versus married couples, you'll see that the brackets for married couples filing jointly are only about 33% wider than for single filers. So the 5.84% marginal rate starts at $11,450 in marginal taxable income for single filers, but it kicks in at only $15,270 for married filers. This means that if 2 people are married, each making $40,000, they are taxed at a higher effective rate as a married couple than they would be as 2 single individuals. While a married couple credit has been introduced into Wisconsin's tax code to mitigate the impact of the marriage penalty, it is not a perfect fix, and it adds unnecessary complexity. Wisconsin is an outlier here. Most states simply double their brackets for married couples to avoid a marriage penalty. So we know Wisconsin's income tax is progressive, but how does the top marginal rate compare to other states? I bet you can guess, it's high. At 7.65%, Wisconsin's top income tax rate is higher than the top rates in all but 8 states and DC. Another thing we spend a lot of time discussing in our book, and something that's been the subject of a lot of debate here over the past few weeks in the legislature, is Wisconsin's standard deduction. Compared to other states, Wisconsin's standard deduction can hardly be considered standard at all. Unlike most states that offer a uniform standard deduction, whether $2,000 or $12,000, Wisconsin has a very complicated, very progressive sliding scale standard deduction that is only available to taxpayers with taxable income below a certain level. In tax year 2018, the maximum standard deduction that can be claimed is $10,580 for single filers and $19,580 for married couples filing jointly, but the amount that can be claimed decreases quickly as income increases, even among the lowest income earners. The standard deduction also phases out completely, such that single filers with Wisconsin income above $103,500 and married couples with income above $121,009 are not eligible to claim a standard deduction at all. Like the state's individual income tax brackets, Wisconsin's standard deduction also contains a marriage penalty, with married taxpayers receiving a smaller standard deduction than they would as two single individuals. For context, Georgia and Kentucky are the only states beside Wisconsin that have a marriage penalty in their standard deduction. And for the sake of simplicity, many states conform to the federal standard deduction as a starting point for their own. With high rates, a complex structure, and multiple marriage penalties, it's easy to see why Wisconsin's individual income tax barely escapes from the ranks of the 10 worst structured state income taxes. This is one area where not just Indiana and Michigan, but also Illinois outperforms Wisconsin, as Illinois, Indiana, and Michigan each has a flat income tax, and each of those flat income taxes is levied at a rate below Wisconsin's second to lowest marginal rate. Now let's take a look at corporate income taxes.
Page 49.
Like most states, Wisconsin has a flat corporate income tax rate, but the rate is on the high side nationally at 7.9%. After businesses pay their corporate income tax, firms with $4 million or more in gross receipts owe what's called an economic development surcharge equal to 3% of corporate income taxes paid, up to a $9,800 cap. Over the past decade, 15 states and even DC have cut their corporate income tax rate, but not once in Wisconsin's history has a corporate income tax rate been reduced. States have recently reduced their corporate income tax rates for several reasons, including their detrimental impact on business investment, their complexity, and their volatility. This chart shows how volatile Wisconsin's corporate income tax collections are compared to individual income and sales tax collections. So why are corporate income taxes such an unstable source of revenue? One big reason is that during an economic downturn or a rough patch in a business cycle, some companies generate little or even no net income. As a result, corporate tax collections spike sharply during good years but collapse during bad years, making the tax far less reliable as a revenue source compared to other more stable tax types. Another factor contributing to this volatility is the fact that the corporate income tax in Wisconsin has been carved up a lot over time, as you can see from this table of Wisconsin's corporate income tax credits. Now, to ameliorate some of the high corporate rate, Wisconsin relies heavily on corporate tax credits and deductions, and these incentives mitigate tax burdens for select industries and activities, but put upward pressure on overall rates. The manufacturing and agriculture credit is the largest corporate credit. As many of you are probably aware, the manufacturing and agriculture credit is a credit equal to 7.5% of income derived from manufacturing and agriculture activities, whether generated by a C corporation or a pass-through entity. With a top individual income tax rate of 7.65% and a corporate income tax rate of 7.9%, it's easy to see how the manufacturing and agriculture credit eliminates most tax liability for manufacturing and agriculture firms. And while it is certainly understandable that Wisconsin would want to mitigate the impact of its high rates, broad-based low-rate taxes are better than high-rate taxes with a lot of carve-outs because businesses do not have access to special credits, bear the full brunt of the state's high corporate and individual income tax rates. And while carve-outs do shield some industries or businesses from high rates, they end up putting upward pressure on the overall rate that applies to non-favored industries. And while manufacturing and agriculture are understandably one of the prides of Wisconsin, an important part of the state's heritage, and some of the biggest state employers, it's short-sighted to only extend business tax relief to certain industries while exposing others to high tax rates. A long-term, more equitable solution would be to reduce business tax rates, including corporate and individual tax rates, for all employers. Next, let's take a look at the state's sales tax. Wisconsin's sales tax is actually very competitive compared to the rest of the nation. Only Wyoming, Hawaii, and Alaska, as well as the 4 states with no state or local sales tax, have lower combined state and average local sales tax rates than Wisconsin. Wisconsin has a 5% state sales tax rate, and counties also have the option of collecting an additional 0.5% local sales tax on top of that. Of Wisconsin's 72 counties, only 5 choose not to collect the 0.5% local sales tax. In addition, the 5 counties surrounding Miller Park and Milwaukee levy a 0.1% sales tax, although those counties can choose to levy the 0.1% tax while forgoing the 0.5% local tax, as Waukesha County chooses to do. These slight local variances result in a combined state and average local sales tax rate of 5.44% for Wisconsin when you look at the state as a whole. As you can see from this table, all of Wisconsin's neighboring states have state sales tax rates above 6% and combined state and local rates up to 8.73%. And while it's a great idea that Wisconsin has a competitive sales tax rate and wants to continue to make it competitive, the state may have trouble keeping its rate low if it continues to exempt so many goods and services from the sales tax base. This table shows the major goods and services that are currently exempt from Wisconsin's sales tax base, including grocery foods, bottled water, gasoline, newspapers, barber and nail services, veterinary services, interior design, fitness clubs, and others. So why are certain goods and services exempted? There's a couple things here. Most goods were once included in the sales tax base, but have been exempted over time. Meanwhile, most services were not originally included in the sales tax because services weren't a big part of the economy when sales taxes were first created in the 1930s. However, as this chart shows, since the 1950s, page 65, purchases of consumer services have grown, while purchases of consumer goods have declined as a share of total U.S. personal consumption. The decline of goods as a share of consumption, combined with the carve-out of many goods over time, has contributed to the erosion of Wisconsin's sales tax base. And the narrowing of the sales tax base puts upward pressure on tax rates elsewhere in the code, such as the individual income tax. Broadening the sales tax base is one of the best things Wisconsin can do to help its tax code keep pace in our 21st century economy.
So right now, out of all the things that you buy, only 37% of it is subject to the Wisconsin sales tax, which means since you are excluding 63%, in order to make sure the rest of the tax keeps generating revenue, the rate must be that much higher.
However, fortunately, apart from a narrower than desirable sales tax base, Wisconsin's sales tax is well structured. One of the reasons for that is the state is a member of the Streamlined Sales Tax Project, which is a voluntary coalition of states that agree to a set of uniformity and simplification standards to achieve a higher level of sales tax consistency among states, which makes it easier for multi-state businesses to comply with so many different tax codes. Today, nearly half the states are members of the Streamlined Sales Tax Project, and these states all agree to change their sales taxes only in ways that comply with certain agreed-upon standards of simplicity and consistency. Wisconsin's compliance with the Streamlined Sales Tax Project is one of the main reasons the state was able to begin requiring online businesses, or those that don't have property or employees in Wisconsin, but make over $100,000 worth of sales or 200 transactions into Wisconsin, are able to begin collecting Wisconsin's sales tax for online purchases made by Wisconsin residents. Now let's look at property taxes. During our meetings throughout Wisconsin, high property tax burdens were the most common complaint, and I'm sure that's no surprise to most of you here today. The legislators and staff in the audience, I'm sure, can attest to this sentiment, as the state has felt pressure to address the property tax in recent years. And when it comes to Wisconsin's property taxes, there's more to the story, though, than meets the eye. The first thing we must remember is, unlike some states, Wisconsin's property tax is almost exclusively a local, not a state, revenue source. Property taxes are the largest tax source for localities, with the local option sales tax serving as a supplement. And while property taxes are a local government issue, the state has felt the need to address taxpayers' concerns and has responded by offering a number of tax credits through the state individual income tax code to offset these local property tax burdens that taxpayers are feeling. Along with these credits, the state also uses what's called a shared revenue program to transfer state tax dollars to local governments using a very complex formula. For context, total state disbursements to counties and municipalities totaled $822 million from the state of Wisconsin to local governments in 2017. While these state initiatives have certainly softened the blow of high local property taxes, they have also weakened the link between locally provided services and their costs to citizens, meaning more local services are now being financed at the state level, and state tax rates are higher than they would need to be otherwise. Now that we've taken a look at each of the major taxes, I'd like to walk through our 4 options for comprehensive tax reform. These options are all approximately revenue neutral, meaning tax cuts in one part of the code are offset by revenue raisers in another part of the code. This allows us to see how the tax code could be reformed while generating the same amount of revenue that it currently does. But it's important to keep in mind that the rates can be dialed up or down to either raise more revenue or offer taxpayers a net tax cut. Each of our 4 options takes a different approach to tax reform, but all 4 options are pro-growth and would improve Wisconsin's standing on our state business tax climate index from 32nd to 14th, 12th, or 6th best in the nation. So what do our tax reform options look like? All 4 of our options have certain characteristics in common. In the individual income tax, all of our options would eliminate the marriage penalty by doubling bracket widths and repealing the married couple credit. They would all make the standard deduction more generous and repeal the itemized deductions credit, a complex provision that would no longer be necessary once taxpayers have access to a new, more generous standard deduction. In the corporate income tax, all our options would conform to the Tax Cuts and Jobs Act's full expensing allowances under Section 168K, which would allow businesses to write off purchases of machinery and equipment within the first year of purchase at the state level, just like they're now allowed to do at the federal level. All our options would also repeal the 3% corporate income tax surcharge, which adds a layer of complexity and tax burdens for businesses. All our options would conform to new federal standards for how businesses treat net operating losses. Federal tax reform changed the federal standard from a 2-year carryback for net operating losses and a 20-year carry-forward allowance to now allow no carrybacks but unlimited carry-forwards capped at 80% of tax liability. Our options also eliminate the throwback rule in the corporate income tax. Throwback rules are complicated provisions that some states like Wisconsin use to capture excess corporate tax collections from multi-state companies by claiming and taxing income, even when that income is not directly associated with the state. Finally, all of our options would broaden the sales tax base, but to different extents depending on the option. Now let's take a look at what makes each of our options unique. So the primary goal in option A is to achieve a flat individual income tax. If Wisconsin wants to create a flat income tax, like Indiana, Michigan, and even Illinois, it could do so with moderate sales tax base broadening paired with a slightly higher sales tax rate of 5.75%. To achieve these kinds of reforms while generating the same amount of revenue, the corporate income tax rate would only be able to come down slightly, from 7.9% to 7%. Option A would also conform to the new, more generous federal standard deduction that was created in the Tax Cuts and Jobs Act, instead of the current sliding scale standard deduction that is only available to taxpayers toward the lower end of the income spectrum. Federal tax reform nearly doubled the federal standard deduction to $12,000 for single filers and $24,000 to married couples, indexed for inflation, and option A would allow that same amount of income to be deductible at the state level. With a new, more generous standard deduction, the state's personal exemption is no longer necessary and is repealed in this option. All these reforms would improve Wisconsin's ranking on our state business tax climate index from 32nd to 12th overall. The main goal in reform option option B is to make moderate reforms to both the individual and corporate income taxes. You can see from the proposed rate schedule how this option would consolidate the state's 4 income brackets into 3, creating a flatter structure with lower rates and narrower bracket thresholds. This option would also repeal the personal exemption while instead conforming to the new, more generous federal standard deduction, making it available to all tax filers. At the same time, option B would drop the corporate income tax rate from 7.9% down to 4.6%. This option would accomplish these goals through moderate sales tax base broadening while keeping the sales tax rate at its current low rate of 5%. And all these reforms combined in option B would improve the state's ranking on our state business tax climate index to 14th overall. The primary goal in option C is to completely repeal the corporate income tax, which is currently one of the biggest impediments to growth and investment in the Badger State. This option would allow pretty substantial individual income tax reforms as well. Option C uses the same individual income tax structure as option B, with 3 brackets instead of 4 and lower rates. Option C also repeals the personal exemption in favor of conforming to the new, more generous federal standard deduction, and all these objectives can be accomplished by a large amount of sales tax base broadening paired with a slightly higher sales tax rate of 5.2%. Option C would improve Wisconsin's index ranking most dramatically from 32nd to 6th best in the nation. Option D presents a path towards simplifying and stabilizing the tax structure, but it does so in a way that retains a lot of the progressivity in the individual income tax code. The option collapses the 4 existing brackets into 3, dropping the middle and top rates slightly. It would also keep the standard deduction essentially the same as it is under current law, but it would eliminate the marriage penalty in the standard deduction by doubling the amount of the standard deduction that can be claimed for married couples filing jointly. However, just like under current law, the standard deduction would phase out completely once taxable income reaches a certain level. Unlike the other options, option D would retain the existing $700 per taxpayer personal exemption. On the corporate side, option D would reduce the corporate rate from 7.9% down to 4%. And this option would achieve all these reforms through moderate base broadening at the existing 5% sales tax rate. Overall, this option would improve Wisconsin's index ranking to 14th overall. So we just went over quite a bit of material, but if there are only 4 things you can take away from this presentation, I hope it's these. Wisconsin's corporate income tax rate is high and a volatile source of revenue. Reducing the corporate rate would lessen the need for industry and employer-specific incentives. Wisconsin's individual income tax rate is high, and the graduated rate structure discourages work, savings, and investment. Third, modernizing the sales tax base is the key not just to a better sales tax, but also to reducing overall rates elsewhere in the tax code. And finally, there's an opportunity cost to maintain the status quo. Not having a stable, simple, modern, fair, and pro-growth tax system is holding the state back from reaching its full potential as an economic leader in the region and also in the nation. That concludes our presentation, but now we look forward to answering any questions you may have. One of our goals at the Tax Foundation is to make all this material as digestible as possible for people because taxes are complicated. Let's face it, they're pretty complex, but that's a good reason why we should be looking for a simpler system, and we think our reforms would create a simpler system. But our goal with our book is to make this a little more digestible for anyone who's interested in learning more about the tax code and what can be done to improve it.
Do most people know about the throwback rule or the limits on the marriage? No, of course not. But I think broadly people understand they pay a lot of property taxes. That income taxes are progressive and maybe a little bit high regionally and nationally. Sales tax, sometimes I pay it, sometimes I don't. Maybe they don't understand why. So I think there is a foundational element out there of understanding that reforms can build on. Because at its core, it's a system that is picking winners and losers and is not fair, whatever your perspective. And so I think there's an opportunity to make changes. Overall,
what are the barriers to talent creation? I'd say they're definitely the corporate income tax and the individual income tax. So any of the plans that reduce those rates are going to be pretty pro-growth and do a lot more to attract business to the state than the current tax code does. So we don't try to pick a best plan. These are 4 very different options, but it's ultimately for taxpayers and legislators to decide what your priorities as a state are and use the tax code to help build upon those strengths. The corporate income tax is responsible for a smaller share of collections overall than the other taxes in Wisconsin. But for the businesses that do have to pay the high corporate rate, they're really hurt by it. And that's part of the reason the MAC and other credits have been introduced to try to recognize that burden and reduce it. But a lot of businesses, if they're not manufacturing or agriculture, are still paying pretty hefty corporate income taxes to the state, which creates a pretty uneven playing field and makes it nice for certain industries. But if you want to attract long-term investment to the state, I would really recommend looking more broadly at your overall goals and whether the overall structure of the code is attractive to business.
Not all taxes are created equal. To collect $1 of revenue from one type of tax, you've got administrative costs on top of that, and then costs of the incentives or disincentives it creates in the economy. Mm-hmm. And research into it has shown that property and sales taxes impose the minimum number of administrative and disincentive costs, while the corporate income tax is the most. I mean, it can be 20 or 30 cents on the dollar to collect $1 of corporate income tax. And so when you think about, when you're evaluating corporate income tax versus other taxes, you have to keep that in mind because it's more than just the revenue you're collecting. It's the pain you're inflicting on the overall economy of what activity you're deterring, because Wisconsin's rate is so much higher than other states. This is the revenue raiser, so this is going to be the point of contention, I think. Every item on that list is going to have a lobby that says, I shouldn't have to collect sales tax on what I sell. Yeah, everybody else has to, but I'm special, I shouldn't have to collect it. And I'm a lawyer, I hear it from my industry where, our position, the ABA, is that the convenience store guy, he's got to collect sales tax on everything he sells, but lawyers, we don't have to collect anything. And I think there's an equity argument to be made there on whether that's right. Economically, you're not going to find an economist that says that makes sense, that one should collect and the other shouldn't. The tax should be the same on all of them. And honestly, I think it's where states are going. There's already half a dozen states that do it already. And if you want to keep the sales tax a vibrant tax, this is where our economy is, on services, and so that's where the tax system will have to go. Otherwise, you're going to have to rely more on property taxes, income taxes, and business taxes.